Welcome to another deep dive. Today we're plunging right into Coinbase Global. That's ticker COIN. Now, this company, it's got this really fascinating paradox going on. It's highly centralized, right? Regulated public American company, but it's the main gateway for over 100 million users into the supposedly decentralized world of crypto. It's essentially the bridge connecting, old school finance 1.0 with this new blockchain stuff, finance 2.0. And it's the biggest U.S. crypto exchange holding billions, heck, hundreds of billions in assets and now in the S&P 500. Well, it's clear Coinbase is sitting at a really critical spot.
Oh, absolutely. And what's so compelling, I think, is exactly that unique position. Coinbase isn't just another tech firm. It's like a living case study if you're interested in the whole crypto economy. It embodies so many of the strategic challenges, the huge risks involved. So our mission today for this deep dive is really to dissect Coinbase's journey, unpack how its business model is changing, look at the big kind of audacious bets it's making for the future, and just map out all the complex forces it's dealing with.
Okay, so to really get Coinbase, we kind of have to go back to the beginning, right? The origin story. It starts with Brian Armstrong, the co-founder. Back in 2010, he saw payment friction, found the Bitcoin white paper. Boom, the light bulb moment. That led to the starting Y Combinator in 2012, teaming up with Fred Ursum, who, interestingly, came from Goldman Sachs. And it's fascinating. Their early users basically told them, hey, I don't have any Bitcoin. So they had to pivot. It wasn't just about a wallet anymore. They needed that crucial buy button. That really unlocked everything.
Yeah, that pivot was key. And it tied into their whole philosophy, trust through compliance. It was a deliberate choice, slower, definitely more expensive than some of the competition.
The more Wild West hikes?
Exactly. They invested heavily in KYC, AML, all that regulatory stuff. Know your customer, anti-money laundering.
Which set the stage for milestones like the big NASDAQ Q direct listing in April 2021. And then just recently, May 2025, getting into the S&P 500 index. Quite a journey.
And that compliance focus directly shapes how their money-making engine has evolved. It used to be all about that volatile transaction revenue, mostly high-margin retail trades back in the day. Now, over 80% of that trading volume is institutional, much lower margins there. So this isn't just a small tweak, it's a major pivot. They're trying to become less of a volatile crypto exchange and more like a predictable foundational piece of financial plumbing.
So the future is less about those trading fees.
Right. The strategic goal is subscription and services revenue. Think more stable, more predictable income streams. We're talking things like revenue sharing on stablecoins like USDC, staking services, earning rewards on proof-of-stake chains like Ethereum, institutional custody that's become absolutely critical, especially with all the spot Bitcoin ETFs from giants like BlackRock needing someone to hold the actual Bitcoin. Plus, they have their Coinbase One subscription for users. It's all about buffering that market craziness.
Okay, but with that shift, who are they even competing against now? Is it still the same players? Because the landscape looks intense. You've got direct exchanges like Binance, Kraken, institutional players like Bullish, DeFi exchanges like Uniswap, and even the big traditional finance firms dipping their toes in, like Robinhood.
It's definitely multi-front warfare.
So what's their defense? Their economic moat?
Well, it's built on a few things. First, brand and trust that compliance focus pays off there. Then regulatory licensing. They've got the hard-to-get New York BIT license. They're prepping for Europe's MiCA rules.
Yeah.
That's a big barrier. Also, network effects. More users, more assets makes the platform more valuable. And for their big institutional clients, there are pretty high switching costs once you're deeply integrated.
But there's a paradox there, isn't there?
Exactly. Here's the strategic puzzle. Coinbase pushes for clear crypto rules to legitimize the space. But by doing that, by making the rules clearer, doesn't that potentially make it easier for the big, well-funded TradFi firms to jump in? It could actually erode that unique compliance advantage they worked so hard to build. Is it a moat or just a head start that's getting shorter?
That's a great point. And their financials really reflect the crypto roller coaster, don't they? You had that explosive 2021 bull run, felt like everyone was making money. Then the brutal 2022 crypto winter. A tough time, followed by a recovery phase in 2023 and 2024. So key things to watch are always those monthly transacting users, MTUs, and the total assets on platform, AOP.
Right. And looking forward, Coinbase is basically staking its future on three really audacious strategic bets, big swings. First, the derivative supercycle. They spend nearly $3 billion buying Deribit, the top crypto options exchange globally. The goal: dominate the crypto derivatives market options, futures which is estimated to be way bigger than just buying and selling crypto directly, and potentially less cyclical revenue.
Okay, bet number one. Derivatives. What's two?
Bet 2, building on Base. That's their own Layer 2 blockchain. Think of it like an express lane built on top of Ethereum. The idea is to onboard the next billion users with super cheap, super fast transactions. They want to create a sort of utility moat with apps built on Base and generate new revenue from sequencer fees like tolls on that crypto highway.
Interesting. Layer 2 is definitely a hot space. And the third bet?
Third, the institutional on-ramp. This leans into their custody role. They're the main custodian for most of those big U.S. spot Bitcoin and now Ethereum ETFs. That means recurring custody fees, and it cements them as this essential regulated infrastructure piece that big money needs to get into crypto safely.
Makes sense. Big bets, but also big risks, right?
Huge risks. There's the ongoing SEC lawsuit. The outcome there could be, well, potentially devastating. Cybersecurity is a constant threat. Remember that 2025 data breach through contractors. That stuff keeps happening. Plus, the market itself is just inherently volatile, and competition isn't letting up.
So how do they manage all that?
They try. Proactive engagement with regulators, pouring money into security, and crucially, that revenue diversification push we talked about, moving beyond just trading fees.
Okay, so wrapping this up, Coinbase has clearly grown up. It's not just an exchange anymore. It's a complex financial tech company fundamentally trying to evolve and insulate itself from those wild crypto market swings.
Exactly. The takeaway is its future really hangs on whether those three big bets pay off. For derivatives, Base as a platform, and locking down that institutional custody role. If you're looking at Coinbase as an investment, it's kind of a hybrid beast, isn't it? It's part growth story, part infrastructure play, like part volatility hedge maybe, and definitely a critical regulatory play. It touches on all those themes.
So here's a final thought to leave you with. We started with that paradox, the centralized gateway to the decentralized world. As Coinbase gets bigger, more regulated, more integrated with traditional finance, what does it actually mean for the promise of Finance 2.0? Is true decentralization getting closer, or is the bridge itself becoming the main destination? Or maybe it's just a necessary step on the way there, something to think about.